My name is Spencer Gray, and welcome to the Gray Report, where we break down everything important that happened in the multifamily industry, real estate, and the economy, kind of in that order, kind of everything in this past week. And this is related to the Gray Report newsletter that comes out every Thursday morning. So if you're not subscribed to that newsletter, hop on over to graycapitalllc.com/newsletter and get it. All kinds of good, interesting stuff. And we had CPI inflation data that came out earlier this week. We're approaching the end of the quarter, so there's a lot of interesting information based on starts and projections in terms of risk and over the next year. But also we've got taxes. Got some clarity on capital gains taxes. Some of the changes that are working through Congress. So we're going to find out a lot more, get our analysis, see what the experts are saying, all the latest research reports. Let's get into it. All right, once again on the Gray Report, again, thank you for taking some time, spending it with us. We've got Matt Bosnuggle. He's the Director of Communications and Marketing here at Gray Capital. Matt's really got a pulse on the industry, multifamily industry, real estate, and the economy. And Matt, I think there was a lot of interesting stuff going on this week. What kind of was catching your attention more than anything?
Yeah, I like you mentioned the clarity on capital gains tax. I think that the information that we got from the latest CPI report was also encouraging, and everything that we're hearing, both in our own experience and in the news, is that the commercial real estate market is just as hot as ever. Maybe a little bit of uncertainty in the office market, but everything else is really doing great. So it's basically pretty good news. Again, there's CPI is not necessarily a crystal ball, but things are looking pretty good. Inflation's not as bad as we thought it was.
Yep. I think it's interesting. It's always a double-edged sword in terms of growth and inflation. Having a little bit in business is good. It's good for assets, but it's not healthy for an economy for inflation to run too hot. And you can't just take one data point. You want to look more like the moving average, where things are going. But Matt, we've really been talking about the possibility that we may be entering, or really in this environment of almost like a Goldilocks situation, not too hot, not too cold, seeing higher levels of growth, but rates still staying low. And so for multifamily, what that translates into is really some pretty solid above average rent growth, but still lower interest rates, so you get some pretty attractive financing, provide some really awesome cash flow potential. But then up at all this liquidity, money sloshing in the system, there's definitely some risks that are associated with that as well. So just looking at the report, Matt, again, like you said, inflation cools, commercial real estate markets are still hot. Again, if you get the newsletter, you're going to get this market snapshot, again, just a really great list of all these reports. But as you mentioned, Matt, you mentioned the CPI article, that came out, or the CPI report coming out of the Bureau of Labor Statistics. Again, that's in the Gray Report. Inflation, definitely cooling off, compared to, where we saw that really strong, almost 1%, at 0.9, but almost 1% of just month over month in June, basically a third of that type of inflation in August, still more than it was really kind of at the beginning of, or this time last year, kind of September, October of 2020. So still elevated, but we are seeing a deceleration, which is healthy, and it's probably going to give Jerome Powell and the Federal Reserve the excuse of saying, we can probably keep interest rates pretty low, we can probably keep the bond buying going. Why stop if inflation really isn't taking off in a dangerous way? What are your thoughts, Matt?
Yeah, I do think, because this is the last kind of major communication that we had from Jerome Powell was very much kind of reemphasizing their commitment to full employment, and kind of hinted at the specter of higher inflation, but that was kind of the countervailing force. And in the absence of that countervailing force, they still have a job to do when it comes to employment. And so that's that's where I think it will fall. Hopefully, is that they now have a continued incentive in and a less of a disincentive to kind of keep things low.
Yeah, I think that's spot on. I did want to come back and look at this. Just a quick breakdown of really what's going on. That makes up the CPI number, because CPI,
Yeah.
they did not include everything, but I did want to just let's look at what's changed. We had that really big print. What was that? That was back in June, and really a lot of that is because of used cars and trucks. Had a 10% from seasonally adjusted changes from the preceding month. 10%, that's huge.
Yeah.
And we had another 10% back in April. And now look what's happened in July and August. It's just, not only does that decrease from 10.5 down to 0.2 in August, it was negative 1.5. So we're actually seeing a little bit of a correction going on in the used cars and trucks. Maybe everybody who needed a used car or truck has already gotten theirs. I don't know. I mean, the chip shortage hasn't really gotten that much better. So we'll see how that happens. But more related to real estate, looking at shelter, it was not as crazy, as compared to used cars and trucks. But we still did see decent. I mean, historically, these are still very these are pretty strong numbers. And we're basically, it was we peaked in June at 0.5, 0.4 in July, and then 0.2 in August. And that's a similar level that we were at in February of 2021. So I see, I think, and maybe this is this the transient, is what we're talking about.
Yeah.
Are we on the other side of that spike, of that instant? It doesn't last a month. It looks like it lasted really several months of this gap up, and now we're at this price levels. And so are we gonna, I can see us having still elevated levels of growth, but decelerating growth until we get to some kind of normalcy. But
Yeah.
we also have $4.5 trillion that's in the pipeline to be spent here in the near future. So it'll be interesting if that changes anything.
Well, and the cynics would say that what's transient is our deceleration. But I do think that it's been 3 months of lowering, or 2 months, I guess, of coming down from that 0.9 to 0.5 to 0.3, and so it does suggest somewhat of a trend. But they did note, I'm not sure if it was in the Wall Street Journal article or in another article, how connected rents are to the CPI calculations. Some of them, it's like a third of that is part of it, and that's a longer term problem. I think that we're just now, for as hot as the housing market is, it is very surprising to me that and the inflation was 0.2 in the past month. We've been hearing all this stuff about people needing homes, and that demand's not going away. So I'm interested to see how that goes in the future.
Yeah. I think, we don't have a crystal ball. I think, but it's going to be interesting to see. I mean, we also have a lot of seasonal stuff going on right now. I mean, we're getting into fall. People are at school. Our kids are in school. The things that were happening in the summer, just there's a lot of seasonal parts of the economy. Now, we're going to have. I'm curious on like I know retail sales numbers came out yesterday, and I don't think we had it in the report because it's not super germane. But I think retail sales numbers, and they're very strong. I'm wondering if that is because we've been talking about Christmas presents, and the whole story of like buy your Christmas presents now, but who knows how long it's going to take. How much that is there truth to that? Sure, retailers love to have a big Christmas season also, and if you probably buy stuff now, you're probably still gonna, at least if I know like how my family operates, we buy stuff like early, but then we still are buying stuff up until Christmas. And it's like I thought we had all the gifts. It's like, oh no, we found a couple more things. So,
and you saw that in the numbers for the used cars. Right. There was a shortage of cars. People needed that transportation for 3 months. It was 10, 7, and 10 inflation. And now it's negative 1.5 for the numbers. So there may be, it's not like that's like the definition right there. People had that demand. They got the cars. The demand was met. And I think that.
I guess, I mean, that makes sense. do people, I mean, you still hear about, there's being car lots being more or less empty.
Hmm.
And maybe that's on the new car side, but I would think that having, the chip shortage and not the
Yeah.
unavailability of new cars would continue to drive up the prices of used cars. So maybe we're just at like at a peak of where they can't pay anymore for, a
Well, and
20-year-old car.
that's a good point too, is that that 10, 7 and 10, those 3 months are still buoying the prices. It's not like a little chip off the price makes it a whole lot cheaper. It's still, and that's another thing, because we're decelerating, but prices are still increasing.
Yeah,
And
yeah.
yeah,
Well, it's like, so 2 months used car price went up 20%,
yeah,
between 2 months, and so now they're down 1.5%, and it's like, oh wow, it's gone down. Yeah, okay, so but it's still up, and I'm not even counting the
yeah,
other month. It's still up 20%. So
yeah.
it's pretty interesting. So I think this dovetails into this interesting good piece from the Wharton School of Business. And some other opinions on inflation. I think it's little educational, but there's some good pullout quotes. Um,
Yeah.
Matt, I think you had a couple points, and then yeah, go ahead. What are your
Well, yeah,
thoughts
it
on
was,
this piece?
it's educational, and I'll give it to them because they're it's
It's a
it's a
school,
yeah, it's a school. So, but I did
very
like
good
how,
school.
yeah, yeah. So, but I hopefully if we'll get a little bit of credibility just by association.
Yeah,
But I love to learn, and this one was really interesting because it explained something that you've explained yourself actually before here, Spencer, in the kind of levers that the Fed has to pull, and two of them really are asset purchases and interest rates. So this this piece really goes into Jerome Powell's latest comments that he made. I think it was his Jackson Hole speech, and where and it really found uh, that he was emphasizing the decoupling of asset purchases and interest rates, not just doing the same thing at the same time. And it was really arguing at the end. The quote is that the Fed is of the view that raising rates prematurely can be worse for lower wage earning groups. So if you curb your asset purchases, that's not as damaging for the lower income and for its kind of employment mission than it is if you curb interest rates.
yeah. I think that it makes sense. I mean, you can forecast this stuff, but also on the reducing your bond purchasing, you can do that slowly. Okay, so we're buying 110 versus 120 billion a month. And it's not going to really affect markets, and you've signaled that months in advance. Essentially, everyone's expecting that to happen. So it's not going to really rock markets, and so there's still plenty of liquidity in for mortgage-backed securities and treasuries. But maybe it's just not extra fuel in the fire where they actually move interest rates. That moves markets a lot more by moving the Fed funds rate, because
Well, and
that
this is,
permeates through.
yeah, yeah. And this may or may not be essentially related on the topic, but I was kind of thinking about what's the best for real estate investors. If you have an asset in this high interest rate environment, you have that asset. If it can pace inflation, and then you just have low interest rates, then that's great. But if inflation goes up so much, even if your assets are pacing inflation and it starts to hurt the economy, then that's not a really good idea.
Yeah, well,
So
exactly. It's like, yeah, you can have great, cheap debt, but if we have, hyperinflation or just spiraling inflation, it's not good for the economy. Now, can you make some money and your assets are going to go up in value? Probably, but do we want to live in a society where like the economy is screwed up and yeah, you've got some assets that are worth a lot, but you can't do anything because
yeah,
all the businesses are closed, or it's
well, and I'm thinking of, for just also from a pure money standpoint, if the economy's doing bad, then maybe not. Maybe your asset's not going to get any
yeah.
renters or anything.
Exactly. It's a very
So it
unhealthy.
can tip over. It seems like. Yeah.
Yeah. Yep. Absolutely. Okay, so that's kind of inflation. We're on inflation watch, seeing what's going on the macro side. This is also macro, but I think it's very important because just we've had so many. I want to talk about taxes, capital gains, and because there's been a little bit of movement, a little bit more clarity, actually really major clarity. This is something that we've been kind of
Yeah.
watching out for, because we've been pursuing a couple of properties with sellers who are very tax sensitive, and in terms of like helping them make a decision on whether they want to sell this year, they want to hold on to it, what they are going to do. And now that there's some a little bit more clarity, some proposals moving through the House Ways and Means Committee actually outlines essentially what these tax increases are going to be, and they are not as aggressive as
Yeah.
what was initially proposed. A lot of people, these numbers have been thrown out there in the past, and I think for a long time, most people did not think the higher numbers, those are just an opening salvo. So Matt, just break it down for us if you don't mind, and I
Yeah.
can hop in any moment
So
as well.
this is a little bit independent from the specific newsletter, but that's what happens when when I get curious. Is we were kind of having a discussion here about putting numbers to things, and some progress was made legislatively and gave us a little bit more clarity. So this Market Watch article really kind of tells the story of what the plans were that Biden had for this for capital gains tax, and then what's been settled on. And for the top earners, it went from a capital gains tax that was planned for Biden from 20% to 36.6. That's a huge number. And the other plan, the alternative plan for House from House Democrats, it's really being hashed out. And I do think it is worth noticing that this topic has been kind of a specter. Associated with their spending bill, like how are you going to spend it, and I don't think
Or
that
how are you going to
Democrats
pay
wanted,
for it? Yeah.
yeah, I don't think that they wanted to put a hard number on it until things, yeah, it's more of a last minute thing to do, and then people start thinking about it. But anyways, instead of changing it from 20 to 36.6, it's 20 to 25%. And then there are surtaxes that are added there that are existing, but essentially it is 31.8% all told, that which involves other surtaxes, but I would say 25%, 20 to 25% is the proposed tax right now from the Ways and Means Committee. And the upshot to all of this is that things are getting, I don't want to say watered down, but they're getting less aggressive. And the worst case scenario is not true. And I would expect things to even get a little bit more moderate as things progress, as these moderate Democrats kind of have objections and things. The story right now is what will be is a story of compromise, and I think it's a movement down from their original kind of ambitious plans.
I don't think there's a ton of appetite to raise taxes while the economy is just starting to recover. And then on one side, we're saying, coronavirus is still with us. Look at the Delta variant, the Gamma variant. But then let's raise taxes to really screw up the economy. I don't think there's just not a lot of appetite for that for me. And then literally was with owners today. We're looking to buy their property, and I spoke to him, and I was like, what's your timeline? I said, before the end of the year. He's like, now we've got some clarity. This is the biggest thing. It's like there was an unknown. I didn't know what was going to happen. We had another owner we're trying to buy properties from. He's like, maybe these taxes are going to go retroactive, and I don't know. I can't make a decision whether it's an excuse or not. It doesn't matter. But they didn't want to make a decision until they just knew what their liability was. They just kind of knew what the environment was going to be. And then this owner I was talking to today, he's like, now we know. Will they be changed in a year or two? Will they go back? Could they go down? Could they go up more? Possibly. It's a roll of the dice. But I know if I sell now before the end of the year, I know what that's going to look like. And so I think that's not. I think that there's a lot of sellers in that mindset who now, okay, let's get this done. And we can see, I could see, not a flood of properties coming to the market. I think a lot of things are already moving to the market, anticipating this. But you're going to have a lot of deals closed by the end of the year, and I would anticipate volume in Q4 2021 being some of the highest volume on record, competing with the Q1 2021 when we saw a lot of deals that did not get done in 2020, got done first quarter. Really, that Q4 in Q4 2020, Q1 2021 were strong, but I think Q4 2021 we're going to see a ton of deals close, a lot
Yeah.
of big deals. So
Mhm.
we'll revisit when we get those numbers in
Markets are
2022, I
getting
guess.
hotter.
Yep. But the what's interesting, and it's a little bit of a tangent, but markets are hot, but there's a lot of price discovery going on right now.
Yeah.
There's people who are trying to sell crap. They're putting a premium on it because they're saying everything's going for whatever door or whatever cap rate, selling on future far out future projections. Brokers telling us, hey, if you're not assuming full trade out rents in year one, you can't be competitive. And we're like, well, that's not how it works. You don't buy a property and you tell all your current residents your rent's gone up by $100, start payment. They have leases. You have to wait till their leases to expire to increase rents. And so you can't like pro forma from day one. You're going to have these like higher rent levels, and you can have a higher GPR, but you're going to have a loss to lease. And so like we're looking at it realistically. There's buyers out there who are like, man, we don't care. Screw the first year. Screw the cash flow. It's hard to compete, but there's just a lot of you have to be very discerning and discriminating on which properties you're going to pursue, because there's some high quality stuff that's out there. We're going after some off market mom and pop owned stuff. Great, so excited to get these deals going. Then we get stuff sent to us, and we're like, you're asking significantly more for a worse property in a worse location, and where do you get off? But then like they're gonna find a buyer for it.
Oh yeah, I remember earlier that I think there was a property that we were interested in, and you went in down and visited, and the number did not justify the property that you looked at. And did it sell?
Well, we'll have to ask. I think they've got under contract. It's not closed, but yeah, someone's going to buy it.
Yeah,
and it's like someone, you deal with it. That's fine.
Yeah,
not for us. But it's like not for us. Anyway, let's keep talking about the multifamily market, Matt.
Yeah.
5 apartment markets likely to overheat. Tantalizing headline. Seemingly, these are also many of the markets that are on many lists as the best markets of all time. So, and I think this, proves the already understood principle of, risk equals return. The markets most likely to overheat are also the ones that are most likely to give you just hugely outsized return. And the culprits on this list, oh man, I guess I don't have the full access to Globe Street, but
you got to sign in.
They've got but they've got the list right here. So it's Phoenix, Raleigh, Durham, Las Vegas, Tampa, and Denver are to be considered the most likely apartment markets to overheat in the coming months, according to Kimberly Byram, principal multifamily Zonda advisory, who presented Tuesday at the MFE conference hosted by Zonda in Las Vegas. In the past, I have gone to the MFE conference. It's a good time. Isn't it just an excuse to hang out in Las Vegas at the Bellagio? Maybe, but I wish I could have gone this year. Anyway, interesting list. Again, a lot of these markets are some of the ones that had problems in the great financial crisis. We also looked at markets like Phoenix when we were, when I interviewed the guys from Berkadia, in terms of looking at kind of the different volatility and risk factors and the beta of different markets. In Phoenix with the demand, they're saying it used to be more of a boom and bust market, but it's really kind of a boom and no bust market because of how much demand. And not all these markets they're all pretty different, especially when it comes to Raleigh, Durham, Vegas. And I guess Vegas and Phoenix has similar drivers. I'd say they have some, obviously they're unique in their different markets. Raleigh, Durham, I think is pretty separate. And then Denver, I would say, is also separate drivers. I think they all have risk of just being oversupplied in general. But Matt, what was your take?
Yeah, so there was a couple articles along those lines of, are they overheating? And then there is a real page that I was kind of measuring it against, and this was the markets with rent growth of 20% or more.
Mm-hmm.
And you see a lot of the same ones, but some of these markets are different. So the markets they listed include Naples, which is not in the not in the Globe Street article, but I think was Tampa in that one? Yeah, Tampa was in it. But Naples wasn't.
Yep, Tampa was in
it. But it does include Phoenix and Las Vegas as well. But I don't see Raleigh-Durham in there, and I don't see and I think there was another one.
No, but Raleigh-Durham's rent growth is like 15 to 19%. So yeah, it's like there's a lot of markets that, I mean, really the point of this article is 20% rent growth is nuts. Come on, let's just be like clear. 20% rent growth is absolutely unprecedented, and there's a list. There's not one. It was one thing when Boise, Idaho saw kind of record rent growth because of it's a smaller market and everyone's moving there. But you had to have a list, and then if we look at the list of just all the markets in above 10%, it's probably 50 markets plus.
Yeah,
just any market with any kind of growth is seeing 10% year over year rent growth or more. And
so and so I also kind of was thinking, there are two elements to market overheating. There's demand and the rent growth is kind of a sign of that, but there's also supply and the kind of future looking. If these markets are expected to overheat, we should look at also construction, and that plays into an older article that we had a couple weeks ago on the newsletter about residential permitting. And you can look at these different cities that they have listed here, the top markets for multifamily permitting. They have Phoenix on there, but there is not. But that's the only one. And what's so interesting to me about Phoenix is they're making they're putting all this supply relatively. And now I think this is again the pandemic, the ceiling. They're doing as much as they can, and they're among the top that are the top in permits, and they're planning all of this construction, but they still can't keep up. The demand still is going to outpace the supply. And I think Phoenix there is kind of an exemplar of this, of the whole market right now. Is we're doing as much as we can, and the demand it's like we're in between a rock and a hard place. There's nothing that we can do except for wait for the supply to come online.
Yeah.
And that kind of underlines the inflation question, and all of this stuff is really all I can think about is how much pressure has got to be on the development and the creation of new housing supply.
Yeah. Well, and it's one thing in markets that you see that much permitting and building going on because the demand, but then there's the markets that like they're stuck in the middle. Like they've got good growth, but they're not like flashy headlines, so they don't get the development. And so, but like the growth is still there. And so, but you're not adding supply, but the demand's continuing to grow until all of a sudden you've got this huge imbalance. And those are the markets that I think are interesting, not the ones that it's like obvious that like it's the top 10 population and job growth, because that the developers, they take the list and that's where they go, and they get oversupplied. Where the prices get bid up, you can't get any cash flow. For appreciation, all day, go for it. You build something. If you're a builder, flipper, all day, every day. If you're a buy and hold cash flow investor, it's gonna be tough.
Yeah, and that's another thing too. For the investment angle, you have to look at where's the competition and where are people looking. And again, like you said, there might be places that don't make these lists, but they make a lot more sense than the flashy Phoenixes of the world.
The flashy Phoenixes, absolutely. All right, Matt. Well, we are unfortunately out of time. Thank you again for being on the Gray Report, and again for all of your work for the Gray Report newsletter. I mean, again, if you haven't subscribed to this channel, subscribe to us now. Give this video a like. Curious in your comments. And then, hop on over to graycapitalllc.com/newsletter. You can sign up for the newsletter, really easy. You just need really your email. But then if you'd like to stay up to date all the time, grayreport.com. We've got all these reports posted all the time, market updates, videos, good stuff. You can rewatch videos like us. Oh, this is me interviewing Michael Blanc. Really cool guy. So check it out. Check out all our content. Get in touch with us, and we'd love to meet you. Subscribe, sign up for the newsletter. Matt, thanks again. This was a great episode of the Gray Report recap. So
thanks.
Good stuff. All right. Stay tuned for the next episode of the Great Report recap. Get ready for the next newsletter coming out next Thursday. We'll see you soon. Thanks.